I'm going to show you two bank accounts. Account 1 belongs to Marcus from Berlin, age 35, saves 1,000 euros per month religiously, has 180,000 euros in his savings account, feels responsible, feels smart. Account 2 belongs to Sophia from Amsterdam, age 35, also saves 1,000 euros per month, has 340,000 euros in assets. Same age, same savings rate, same time period. 160,000 euros difference. What's the difference? Marcus saves, Sophia invests. But here's what nobody tells you. Sophia didn't take crazy risks. She didn't get lucky. She didn't inherit money. She didn't trade crypto or time the market. She simply understood something that 90% of Europeans don't. In a world with 3 to 8% inflation and 0 to 2% savings rates, saving money is losing money. The wealthy Europeans don't save. They invest strategically, tax efficiently, long term. In the next 60 minutes, I'm going to show you exactly how they do it. The platforms they use, the assets they buy, the mistakes they avoid, the tax strategies they employ. This is the European investor's playbook, not American advice that doesn't work here, not theory from textbooks, real strategies that work in high-tax, heavily regulated European markets. Let's begin.
Let me show you the silent wealth killer that's destroying European financial futures. The math that banks don't want you to see. You have 50,000 euros in a German savings account. Interest rate 1% per year. Inflation 6% per year. 2022-2023 average, now lower but still significant. Your money grows to 50,500 euros, but prices increased 6%. So you need 53,000 euros to buy what 50,000 euros bought last year. Real result? You lost 2,500 euros in purchasing power, despite saving and getting interest. This is happening to millions of Europeans right now. Netherlands, 400 billion euros in savings, earning near zero interest. Germany, 2.5 trillion euros in savings and low-interest deposits. France, 500 billion euros in livret A accounts, earning 3%, barely beating inflation. UK, 1.8 trillion euros in savings accounts, earning 1 to 4%. All this money slowly losing value, guaranteed. But wealthy Europeans? They hold minimal cash, just 3 to 6 months of expenses. Everything else is working for them in investments. Why Europeans save instead of invest? Cultural reason, Germany's hyperinflation trauma 1920s, Southern Europe's banking crises 2010s, UK's conservative banking culture. These created deep-seated fear of market risk. Structural reason, European pension systems made people think retirement was handled. The government would take care of them. So why take risks? Educational reason, schools teach nothing about investing. Parents who never invested can't teach their kids. Financial literacy gap. Result? Europeans are the most educated, highest-earning savers in the world who are getting poorer every year because of inflation.
The inflation lie you've been told. Government says inflation is 2 to 3% target. You're told your savings are safe if interest rates match inflation, but that's a lie. Here's why. Official inflation versus real inflation. Official EU inflation calculation includes things you don't buy regularly. Big TVs getting cheaper, technology deflating. This pulls the average down. But what about things you actually need? Germany, 2015 to 2025. Rent in Munich plus 45%, officially counted as only partial weight. Healthcare contributions plus 38%, electricity plus 67%, groceries plus 28%, childcare plus 35%. Official inflation those 10 years, about 2% per year, equals 22% total. Real cost of living increase, 35 to 40%. Netherlands 2015 to 2025. Rent in Amsterdam plus 52%. Energy costs plus 89%. Groceries plus 31%. Health insurance plus 43%. UK 2015 to 2025. London rent plus 38%. Council tax plus 33%. Energy plus 78%. Food plus 27%. Your purchasing power dropped 30 to 40%, while government said everything's fine, inflation is only 2%. Meanwhile, asset prices, stocks, real estate, businesses grew 80 to 150% in the same period. The wealth transfer is simple. People holding cash lost 30 to 40% purchasing power. People holding assets gained 80 to 150% in value. This is the largest wealth transfer in modern European history, and it's still happening. If you're holding more than 6 months of expenses in cash, you're choosing to get poorer.
What wealthy Europeans hold instead? Let me show you the actual asset allocation of wealthy Europeans versus average Europeans. Average European, 100,000 euro net worth. 60% cash/savings, 60,000 euro. 25% primary residence equity, 25,000 euro. 10% pension fund, 10,000 euro. 5% investments, 5,000 euro. Majority in inflation-losing assets. Wealthy European, 1 million euro plus net worth. 5% cash, 50,000 euro, just enough for emergencies. 35% real estate, 350,000 euro, rental properties, not just home. 30% stocks/ETFs, 300,000 euro. 15% business equity, 150,000 euro, own or part-owned businesses. 10% bonds/fixed income, 100,000 euro. 5% alternative, 50,000 euro, crypto, commodities, collectibles. Majority in inflation-beating, income-producing assets. Key differences. Cash, average hold 60%, wealthy hold 5%. Wealthy use cash as a tool, not a goal. Real estate, average holds only their home, expense. Wealthy hold income properties, assets. Stocks, average scared of volatility, wealthy understand long-term compounding. Business equity, average never considered, wealthy use holding companies and ownership stakes. The wealthy aren't smarter, they just understand cash is for spending soon, not for storing wealth. Assets are for growing wealth, not for spending soon. Your savings account isn't protecting you, it's destroying you.
The compound interest revelation. Let me show you the most powerful force in wealth building. Albert Einstein supposedly called it the eighth wonder of the world. Compound interest. But not in the boring way teachers explained it, in the way it actually changes European lives. Scenario: 1,000 euros per month for 30 years. Option A. Savings account at 1%. Monthly, 1,000 euros. Annual return, 1%. After 30 years, 419,000 euros. Real value after 3% inflation, 172,000 euros. You saved 360,000 euros, got 419,000 nominal, but it only buys what 172,000 euros buys today. You barely gained. Option B, diversified ETF portfolio at 7%. Monthly, 1,000 euros. Annual return, 7%, historical European equity average. After 30 years, 1,220,000 euros. Real value, after 3% inflation, 502,000 euros. Same 360,000 euros saved. Result, 1.2 million euros nominal, 502,000 euros real value. You nearly 3x'd your money in real terms. The difference? 330,000 euros in real wealth from the same monthly savings. This is what every European understands at age 25 that poor people learn at 55, too late. But it gets better with time. Age 25 to 55, 30 years at 7%, 1,000 euros per month equals 1.2 million euros. Age 35 to 55, 20 years at 7%, 1,000 euros per month equals 521,000 euros. Age 45 to 55, 10 years at 7%, 1,000 euros per month equals 173,000 euros. Starting 10 years earlier equals 7 times more wealth. Starting 20 years earlier equals 2.3 times more. The first 10 years of investing are worth more than the last 20 because of compound interest. This is why every European family starts their kids investing at 18, not 40. If you're 25 reading this, you have the biggest wealth-building advantage you'll ever have: time. If you're 35, you still have massive advantage, but you must start now. If you're 45, you can still build significant wealth, but you need higher contributions. If you're 55, you're in catch-up mode. Higher risk, higher contributions required. The best time to start was 10 years ago. The second best time is today.
Let's start with the foundation of European wealth building, ETFs. What is an ETF? Exchange Traded Fund, a basket of stocks you buy as one product. Example, VWCE, Vanguard FTSE All World. Contains 3,700 plus companies from 50 plus countries. Includes Apple, Microsoft, ASML, Novo Nordisk, LVMH, etc. One purchase gives you piece of global economy. Why ETFs are perfect for Europeans? Reason 1. Diversification without complexity. Instead of researching individual companies, you own thousands. One stock crashes, it's 0.03% of your portfolio. Barely matters. Reason 2. Low costs. VWCE charges 0.22% annually. German actively managed fund, 1.5 to 2.5%. Over 30 years, that 2% difference costs you 40% of your wealth. Reason 3. Passive management. No need to watch markets daily. No stress. Set up monthly automatic purchase. Ignore. Get rich slowly. Reason 4. Tax efficiency. Accumulating ETFs. Reinvest dividends automatically. Defer tax until you sell. Better than distributing ETFs that create annual tax events. European ETF Selection Guide. For broad global exposure, VWCE, Vanguard, All World, 0.22% TER, 3,700 plus stocks. IWDA, iShares MSCI World, 0.20% TER, 1,500 plus developed market stocks. EIMI, iShares MSCI Emerging Markets, 0.18% TER. Add to IWDA for complete coverage. For Europe-focused, VEUR, Vanguard, Europe, 0.10% TER, if you believe in European growth. EXS1, iShares STOXX Europe 600, 0.20% TER, 600 largest European companies. For U.S. exposure, VUAA, Vanguard, S&P 500, 0.07% TER, 500 largest U.S. stocks. CSPX, iShares Core S&P 500, 0.07% TER. Same thing, choose by price. For dividends, HYLD, Vanguard High Dividend Yield, 0.29% TER. For income focus, SPYD Alternatives in European wrappers. Critical, use Irish domiciled ETFs. ETFs starting with IE00BK are Irish domiciled. These have better U.S. dividend withholding tax treatment, 15% versus 30%, EU regulatory protection, tax transparency. Avoid U.S. domiciled ETFs if you're European, higher withholding taxes. Country-specific considerations. Netherlands, Box 3 taxation on deemed return, not actual. Accumulating ETFs, same treatment as distributing. No capital gains tax on sale. Strategy, buy and hold forever. It's tax-free. Germany, 26.375% tax on gains and dividends, 1,000 euros allowance per person, 2,000 euros couples. Accumulating ETFs defer tax until sale. Strategy, use accumulating ETFs, harvest 1,000 euros gains annually tax-free. England, capital gains tax at 10 to 20%, £3,000 annual exemption, reduced from £12,300. Use ISA wrapper for tax-free growth. Strategy, max ISA, £20,000 per year. Use accumulating ETFs outside ISA. France, 30% flat tax on gains and dividends, PFU. PEA, Plan d'Épargne en Actions, for EU stocks, tax advantages. Strategy, use PEA for European ETFs, regular account for global. Belgium, no capital gains tax if good family father investing. Avoid speculation, frequent trading. 0.12% transaction tax on purchases. Strategy, buy and hold forever. It's tax-free. The three-fund European portfolio. Simple but effective allocation. 70% world stocks, VWCE or IWDA, 20% emerging markets, EIMI or just include in world, 10% European bonds for stability, or even simpler, 100% VWCE, world stocks, accumulating, rebalance annually. That's it. This beats 90% of active investors.
Broker selection in Europe. Your broker choice affects your returns significantly. Here's how to choose. Top European Brokers 2026. Interactive Brokers, IBKR. Pros: low fees, huge selection, professional platform, available EU-wide. Cons: complex interface for beginners, customer service not great. Best for serious investors, larger portfolios, 50,000 euros plus. Fees: IBKR Lite, free trades for U.S. stocks, small fee for EU, or tiered pricing. DeGiro. Pros: very low fees, simple interface, good for beginners. Cons: limited customer service, was sold to Flatex, German bank. Best for European stocks and ETFs, beginners. Fees: free ETF list, one free buy per month, 1 to 3 euros per trade otherwise. Trade Republic, Germany. Pros: free trades, beautiful app, 4% interest on cash, German bank security. Cons: limited to Germany, Austria, France, Spain, Italy. Best for German/EU investors, mobile first. Fees: €1 per trade, previously free. Scalable Capital, Germany. Pros: flat fee or free options, automatic tax handling for Germans. Cons: Germany focused. Best for German investors who want simplicity. Fees: €299 per month or €499 per month for free trades. Trading 212 UK/Bulgaria. Pros: commission-free trading, good app. Cons: payment for order flow model, UK-based, post-Brexit complexity for EU. Best for UK investors primarily. Fees: zero commissions, makes money from spreads and lending shares. DeGiro versus IBKR for serious investors. Portfolio less than 20,000 euros, use DeGiro, simplicity, low minimums. Portfolio 20,000 to 100,000 euros. Either works, choose based on interface preference. Portfolio greater than 100,000 euros. IBKR, lower cost at scale, more features, margin or options if needed. Critical, check tax reporting. German brokers, Trade Republic, Scalable Capital, automatic tax reporting, super easy. DeGiro, IBKR, you must report manually, more work but doable. For Germans, German broker saves hours of tax filing headaches. For Dutch, French, etc., doesn't matter as much. Choose best platform. My recommendation: start simple. DeGiro or Trade Republic for the first 50,000 euros. Graduate to professional, IBKR, when you know what you're doing. Don't overthink this. Pick one, start investing. You can always transfer later.
Asset allocation by age. Your asset allocation should change with age. Here's how. Ages 20 to 35, growth phase. Recommended allocation: 90% stocks, ETFs, 10% cash, emergency fund, 0% bonds. You don't need safety yet. Why? Because you have 30 to 40 years until retirement. You can weather any market crash. Bonds barely beat inflation. You need growth, not safety. Specific: 70% World Stocks ETF, VWCE, 20% Emerging Markets or Small Cap, higher risk, higher return, 10% cash. Strategy: aggressive accumulation. Invest 500 to 1,500 euros a month. Never sell. Watch it crash 40% and keep buying. This builds wealth. Ages 35 to 50, accumulation phase. Recommended allocation: 80% stocks, 15% bonds or real estate, 5% cash. Why? Because still long time horizon, adding some stability. Probably have mortgage, kids, need buffer, but still need growth. Specific: 60% world stocks, 20% real estate, rental property or REIT ETFs, 15% European or global bonds, 5% cash. Strategy: max out contributions. This is peak earning years, 1,500 to 3,000 euros a month invested. Add rental property if possible. Ages 50 to 65, pre-retirement phase. Recommended allocation: 60% stocks, 30% bonds or fixed income, 10% cash. Why? Because you can't afford major crash right before retirement. Need more stability, but still need some growth for 20-plus years retirement. Specific: 40% world stocks, 20% dividend-focused stocks or ETFs, income, 30% bonds, short-duration European bonds, 10% cash. Strategy: shift gradually. Don't sell all stocks at once. Reduce risk slowly over 10 years. Ages 65 plus, retirement phase. Recommended allocation: 40% stocks, 40% bonds or fixed income, 20% cash or short-term investments. Why? Because you're withdrawing, need stability, but you might live 30 or more years, need growth. Balance income with preservation. Specific: 30% dividend stocks or ETFs, monthly income, 10% growth stocks, long term, 40% bonds, stability, 20% cash, living expenses for 2 to 3 years. Strategy: the 4% rule. Withdraw 4% of portfolio annually. 500,000 euro portfolio, 20,000 euros a year. Adjust for inflation. European-specific considerations. Netherlands, lower stock allocation due to Box 3 tax penalty on gains, more real estate. Germany, higher bond allocation. Germans love security. But don't go crazy, you need growth. UK, maximize ISA for tax-free growth. Keep high stock allocation in ISA. France, use PEA for stocks, Assurance Vie for bonds. Belgium, 100% stocks if you want no capital gains tax, but still diversify for safety. The rule of 110. Old rule, stock allocation equals 110 minus your age. Age 30, 80% stocks. Age 50, 60% stocks. Age 70, 40% stocks. Still works as rough guide. Adjust based on risk tolerance.
Dividend versus growth strategy. Should you invest for dividends or growth? Europeans ask this constantly. The answer depends on your country's tax system. Growth strategy, capital gains focus. Buy stocks or ETFs that don't pay dividends. They reinvest profits. Share price grows. Advantages: tax deferral, no tax until you sell. Compound growth, reinvested profits compound faster. Lower tax, capital gains often taxed lower than dividends. Best for young investors, 20 to 45. High income earners, defer tax to retirement. Germans, capital gains 26.375%, but only when sold. Dutch, box 3 doesn't distinguish, but growth means less annual tax events. Disadvantages: no regular income. Must sell shares for cash flow. Psychological, harder to see progress. Dividend strategy, income focus. Buy stocks or ETFs that pay regular dividends, 3 to 5% annual yield. Advantages: regular income, cash every quarter. Psychological satisfaction, see money coming in. Passive income, don't need to sell shares. Bear market resilience, income even when prices drop. Best for pre-retirees, 50 plus. Early retirees need income. Belgians, dividends taxed once, no capital gains tax, so dividends can work. Disadvantages: tax drag, dividends taxed annually, compound slower. Lower total return. Studies show growth beats dividends long term. In some countries, dividend tax is higher. Country-specific optimal strategy. Netherlands. Doesn't really matter. Box 3 taxes deemed return regardless. Slight preference for growth, fewer tax reporting events. But dividend income can help prove actual return versus deemed. Germany. Growth is better. Defer 26.375% tax until sale. Use accumulating ETFs. In retirement, switch to dividend ETFs for income. UK. Growth in ISA. Tax-free growth forever. Dividends outside ISA. £1,000 dividend allowance. In retirement, use dividend allowance strategically. France. Growth is better. 30% PFU on dividends hurts. Use PEA for growth stocks or ETFs, tax advantage after 5 years, and Assurance Vie for tax-efficient income later. Belgium. Unique case. No capital gains tax, but dividends taxed at 30%. Strategy: growth stocks, never sell, no tax, live off 0.1% per year and leave it to kids tax-free. Portugal, NHR. Growth, foreign capital gains tax-free for 10 years. Dividends often also tax-free under NHR. Either works, but growth compounds better. My recommendation: ages 20 to 50, 100% growth. Use accumulating ETFs. Reinvest everything. Defer all taxes. Maximize compound growth. Ages 50 to 60, transition. 70% growth, 30% dividend. Start building income stream. Reduce volatility. Ages 60 plus, income focus. 40% growth, maintain purchasing power. 60% dividend or fixed income. Live off income, preserve capital. The math: 500,000 euros in growth stocks at 8% annual equal 40,000 euros growth equal 8,000 euros tax, 20%, equal 32,000 after-tax growth. 500,000 euros in dividend stocks at 4% yield equal 20,000 euros dividends equal 5,000 euros tax, 25%, equal 15,000 euros after-tax income plus small price growth. Over 20 years, growth strategy results in 1.8 million total value. Dividend strategy results in 1.2 million. Growth wins for wealth building. Dividends win for current income and psychology.
Choose based on your life stage and emotional needs, but understand the trade-off.
Advanced European Strategies. Real estate investment across Europe. Let's talk real estate, the wealth builder that Europeans understand better than any other asset. But most Europeans only own their home. That's not investment. That's an expense that happens to appreciate. Investment real estate generates income while appreciating. Here's how to do it right. Best European Cities for Rental Investment 2026. Tier 1. High Yield, High Growth. Lisbon, Portugal. 5 to 6% gross yield, 8 to 10% annual appreciation, golden visa, tourist demand. Valencia, Spain. 5 to 7% yield, lower prices than Barcelona or Madrid, growing city. Porto, Portugal. 6 to 8% yield, cheaper than Lisbon, same growth. Berlin, Germany. 3 to 4% yield, but 10-year hold, tax-free gains, strong rental demand. Tier 2. Stable, lower risk. Amsterdam, Netherlands. 3 to 4% yield, high prices but stable, housing shortage. Munich, Germany. 2 to 3% yield, expensive but very stable, tech hub. Copenhagen, Denmark. 3 to 4% yield, stable Nordic economy, high rental demand. Tier 3. Speculative, higher risk. Athens, Greece. 6 to 8% yield, recovering economy, tourist hotspot. Budapest, Hungary. 7 to 9% yield, nomad destination, political risk. Tallinn, Estonia. 5 to 6% yield, tech hub, small market. The European rental property math. Example, €250,000 apartment in Valencia. Purchase, €250,000. Down payment, 25%, €62,500. Mortgage, €187,500 at 3.5% for 25 years, €940 per month. Monthly costs. Mortgage, €940, property tax, €80, HOA or community, €100, insurance, €30, maintenance reserve, €100, total, €1,250 per month. Monthly income, rent, €1,400 to €1,600 per month. Cash flow, €150 to €350 per month positive. But the real wealth is, Year 1, €2,400 cash flow plus €5,000 appreciation equals €7,400 on €62,500 return, 12% ROI. Year 5, paid down €15,000 mortgage, property worth €290,000, gained €55,000 equity. Year 10, paid down €35,000 mortgage, property worth €350,000, gained €135,000 equity. This is how Europeans build €500,000 to €1,000,000 real estate wealth on modest salaries. Country-specific strategies. Germany. Buy residential property. Hold 10 years for tax-free capital gains. Use depreciation or AFA to reduce taxable income. Target growing cities. Leipzig, Dresden, Erfurt. Cheaper than Munich or Berlin. Netherlands. Hard to cash flow with high prices. Consider buying through BV or corporation for different tax treatment. Or buy in Belgium or Germany and manage remotely. Or focus on high-yield cities outside Amsterdam or Utrecht. UK. Buy through limited company, better tax treatment post-2016 changes. Target northern cities like Manchester, Leeds, Liverpool, better yields than London. Use mortgage interest deduction in company structure. HMO, house in multiple occupation, for higher yields. France. Look for the Pinel law for new rental properties, tax reduction. Consider SCI structure for multiple owners.
Target Lyon, Bordeaux, Nantes, growth and yields. Avoid Paris unless very high budget. Portugal. NHR regime makes rental income attractive. Golden visa, ending for some property types. Check current rules. Target Lisbon, Porto for stability. The Algarve for tourist rentals. Spain. Barcelona, Madrid, expensive but stable. Valencia, Malaga, Seville, better yields. Canary Islands for year-round tourist rentals. Watch for local rental restrictions. Barcelona, very strict. Belgium. No capital gains tax, but rental income taxed progressively up to 50%. Still worthwhile for appreciation. Target Brussels, Antwerp, Ghent. Common mistakes. Buying in your own expensive city for convenience. Buy where the numbers work, manage remotely. Expecting real estate to be passive. It requires management or property manager. Expecting real estate to be passive. It requires management or property manager. Over-leveraging 90 to 100% mortgages. Keep 75 to 85% LTV for safety. Ignoring vacancy and maintenance costs. Budget 1 to 2 months vacancy, 0.5 to 1% maintenance annually. Forgetting about taxes and transaction costs. In Spain, transaction costs are 10 to 12% of purchase price. Real estate is powerful, but it's not passive. It's hands-on wealth building.
Tax loss harvesting, European version. Americans love tax loss harvesting. Europeans can use it too, but differently. What is tax loss harvesting? Selling investments at a loss to offset capital gains, reducing your tax bill. Where it works in Europe. Germany. Capital gains taxed at 26.375%. Losses offset gains in the same year. Can carry forward losses to future years. Strategy. Harvest losses in December, buy back in January. No wash sale rule. Example, you sold stock A for €10,000 gain, tax €2,638. You're holding stock B with €10,000 loss. Sell stock B before year end, buy back after. Net gain €0, tax €0. Saved €2,638. UK. Capital gains tax at 10 to 20%. Annual CGT allowance £3,000. 30-day wash sale rule. Can't buy back the same security for 30 days. Strategy. Sell losers, buy similar but not identical investment. Example, sell VWCE, all-world ETF at loss. Wait 30 days, buy SWDA, different all-world ETF, similar holdings. Loss captured, exposure maintained. France, 30% flat tax on gains, PFU. Losses offset gains, can carry forward losses. Strategy similar to Germany, harvest losses. Netherlands, Box 3 taxation doesn't really apply. No capital gains tax on sale. Tax is on deemed return regardless. Strategy, tax loss harvesting is irrelevant. Belgium, no capital gains tax for normal investors. Tax loss harvesting irrelevant, unless you're trading professionally or speculatively. Advanced strategy, geographic tax optimization. Buy European stocks through Irish ETFs, lower U.S. dividend withholding. Hold in accumulating ETFs, defer all taxes. Only sell in low-income years, retirement, sabbatical. Use personal allowances every year, €1,000 Germany, £3,000 UK. This is legal tax minimization, not evasion. Investing during market crashes. Every European investor will face market crashes.
How you react determines if you build wealth or stay poor. European market crashes since 2000. Dot-com crash, 2000 to 2002. MSCI Europe minus 53% from peak. Recovery time, 7 years, 2009. Lesson: tech bubbles pop. Financial crisis, 2007 to 2009. MSCI Europe minus 59% from peak. Recovery time, 6 years, 2013. Lesson: banks aren't safe. Governments intervene. Eurozone debt crisis, 2010 to 2012. European stocks minus 25% dip. Southern Europe hit hardest. Recovery 2013 to 2014. COVID crash, Feb to March 2020. European stocks minus 35% in 4 weeks. Recovery time 5 months, fastest in history. Lesson: don't panic sell. Crashes can recover fast. 2022 inflation crash. European stocks minus 20%. Bonds also fell, unusual. Recovery still ongoing, 2024 to 2026. What wealthy Europeans did. During crashes, they bought. When everyone panicked and sold, wealthy Europeans increased monthly investments, used cash reserves to buy at discounts, bought quality stock ETFs at 40 to 50% off, stayed calm, didn't check portfolios daily. After crashes, they profited massively. Those who bought in March 2009, 300% gains by 2015. Those who bought in March 2020, 80% gains by 2021. Those who bought in 2022, 40% gains by 2024. What average Europeans did? During crashes, they panicked, sold at the bottom, locking in losses, moved to cash, missed recovery, stopped monthly investments, the worst time to stop, checked portfolios 10 times a day, increasing stress. After crashes, they regretted, stayed in cash, missed recovery gains, bought back at higher prices, repeated the cycle next crash. The winning strategy? Dollar cost averaging. Invest same amount every month regardless of market. Example: January, market high, buy 1,000 euros, 10 shares at 100 euros. March, market crash, minus 40%, buy 1,000 euros, 25 shares at 40 euros. June, market recovery, plus 50%, buy 1,000 euros, 13.3 shares at 75 euros. Average cost, 63 euros share, not 100 euros. Market returns to 100 euros, you're up 58%, not just back to even. European implementation. Set up automatic monthly purchase. DeGiro, free ETF purchases monthly. Trade Republic, €1 per trade, set up savings plan. Scalable capital, automatic savings plan. Never look at prices, just buy automatically. In crashes, don't check portfolio. Increase investment if you can. Cash reserves for this. Remember, stocks on sale. Read history. Markets always recover. In euphoria, don't get greedy. Keep buying steadily. Don't try to time the top. Rebalance if one asset class is way up.
Behavioral finance mistakes. Your biggest investing enemy isn't the market, it's you. European investing mistakes. Mistake 1. Home country bias. Germans overweight German stocks. Dutch overweight Dutch. French overweight French. Why it's bad? Your job is in that country. Your home is in that country. Your pension is in that country. Your stocks shouldn't also be concentrated there. If German economy struggles, you lose job, house value, stock portfolio. Disaster. Fix maximum 20% in your home country, other 80% global. Mistake 2, analysis paralysis. Spend 6 months researching the perfect investment. Meanwhile, inflation ate your cash and you missed a 15% market gain. Perfect is the enemy of good. Fix. Pick VWCE or similar. Start investing. Refine later. Mistake 3. Timing the market. I'll wait for the crash to buy. The crash comes, you're scared, don't buy. Market recovers without you. Fix. Time in market beats timing the market. Just buy now. Mistake 4. Following hot tips. Your colleague made 50% on some stock. You buy, it crashes. Fix. Ignore tips. Stick to boring index ETFs. Mistake 5. Panic selling. Portfolio drops 20%. You sell to preserve capital. Market recovers 30%. You missed it. Fix. Never sell during crash. Better, buy more. Mistake 6. Overconfidence after success. Made 30% last year. Think you're genius. Take bigger risks. Lose 40%. Fix. Luck and skill look the same short term. Stay humble. Mistake 7. Lifestyle inflation after gains. Portfolio up 20,000 euros. Buy 20,000 euro car. Portfolio drops 30,000 euros. Panic. Fix. Never spend unrealized gains. The wealthy European mindset. They think long-term, 10 to 30 years, not 10 to 30 days. They automate everything, remove emotions from decisions. They ignore noise, don't read financial news daily. They stay course, same strategy for decades. They rebalance mechanically, once per year, no emotion. Investing success is 10% strategy, 90% psychology. Master your emotions, build wealth. Independence in Europe. FIRE, financial independence, retire early. Can Europeans do it? Yes, but differently than Americans. The FIRE formula. Target, 25x your annual expenses invested. Withdrawal rate, 4% per year. Result, money lasts forever. Example, annual expenses 40,000 euros. Target portfolio 1 million euros, 25 times 40,000. Withdrawal 40,000 euros per year, 4% of 1 million. Portfolio grows 7% year. You take 4%, inflation eats 3%, balance maintained. European FIRE challenges. Challenge 1. Higher cost of living. Amsterdam, Munich, London, 40,000 euros plus to live modestly. Requires 1 million euros plus portfolio. Hard to achieve before 50. Solution. Geographic arbitrage. Work in high salary country, Germany, Netherlands, Switzerland, 60,000 to 90,000 euros. FIRE in lower cost country, Portugal, Spain, Greece, 25,000 to 35,000 euros lifestyle. Need only 625,000 to 875,000 euros. Challenge 2. Healthcare. Americans include healthcare in calculations, $1,500 to $2,000 per month. Europeans have public healthcare, but private insurance if retiring early and moving countries. Portugal. NHR residents can use public healthcare, about 30 euros per month. Spain. Similar. Public healthcare accessible. Netherlands. Mandatory insurance, 120 to 150 euros per month. Germany. Public insurance based on income can be 200 to 800 euros per month when self-employed. Solution. Factor 100 to 300 euros healthcare in FIRE calculation. Challenge 3. Pension gaps. Retire at 45, but state pension starts at 67. 22-year gap with no state pension income. Solution. Build private portfolio larger to cover the gap.
or plan partial retirement, part-time work until 67, or contribute voluntary to state pension. Netherlands allows this. European FIRE variations. Lean FIRE, 600,000 to 800,000 euros portfolio, 24,000 to 32,000 euros annual spending. Live in low-cost European area, minimalist lifestyle. Achievable by 40 to 45 with high savings rate, 50% plus. Example, retire to a small town in Portugal, Spain, or Greece. Regular FIRE, 1 million to 1.5 million euros portfolio, 40,000 to 60,000 euros annual spending. Middle-class European lifestyle. Achievable by 45 to 50 with 40% plus savings rate. Example, retire in secondary cities like Porto, Valencia, Nice. Fat FIRE, 2 million to 3 million euros plus portfolio, 80,000 to 120,000 euros plus annual spending. Luxury lifestyle maintained. Achievable by 50 to 55 with 50% plus savings rate plus business success. Example, retire in Amsterdam, Munich, Zurich, and maintain high lifestyle. The European FIRE timeline. Salary 60,000 euros net, save 50%, equals 30,000 euros per year. Year 0, 0 euros. Year 5, 172,000 euros equals 30K times 5 plus 7% growth. Year 10, 414,000 euros. Year 15, 753,000 euros. Year 20, 1.23 million euros. At 20 years, FIRE is achieved with 1.2 million euros, supports 48,000 euros yearly spending. Start at 25, FIRE at 45. Start at 30, FIRE at 50. Geographic arbitrage examples. Scenario 1, the digital nomad. Age 35. Location, Amsterdam, expensive. Income, 75,000 euros gross, 50,000 euros net. Saves 60% equals 30,000 euros per year. Current portfolio, 150,000 euros. Goal, FIRE at 45 with 750,000 euros. Move to Lisbon or Valencia. Lifestyle, 30,000 euros per year. Result, early retirement at 45. Live well. Scenario 2, the partial FIRE. Age 40. Location, Munich. Income, 80,000 euros gross, 52,000 euros net. Saves 40%, equals 21,000 euros per year. Current portfolio, 280,000 euros. Goal, partial FIRE at 50 with 650,000 euros. Strategy, work part-time 20 hours per week, portfolio covers the rest. Result, freedom at 50, keep working by choice. Scenario 3, the late starter. Age 45, location, Paris. Income, 70,000 euros gross, 45,000 euros net. Saves 50% equals 22,500 euros per year. Current portfolio, 50,000 euros. Goal, FIRE at 60 with 800,000 euros. Challenge, only 15 years to build. Solution, increase income plus side business plus higher contributions. Result, comfortable retirement at 60. Is European FIRE realistic? Yes, with high savings rate, 40 to 60%, geographic flexibility, 15 to 25-year timeline, modest lifestyle expectations. Not for everyone, but absolutely achievable.
Multiple income streams. Wealthy Europeans don't rely on one income source. They build multiple streams. The 5-stream European model. Stream 1, salary or primary income, active, 40,000 to 80,000 euros per year. Requires your time, most stable but limited growth. Should be 40 to 60% of income early on. Stream 2, side business,
Active to passive, 10,000 to 40,000 euros per year. Requires time initially, can systematize. Tax efficient through business structure. Should grow to 20 to 40% of income. Stream 3, real estate rental, semi-passive. 6,000 to 30,000 euros per year, 1 to 3 properties. Requires some management. Leverage, mortgages, amplifies returns. Should be 10 to 20% of income. Stream 4, investment portfolio, passive. 5,000 to 25,000 euros per year, dividends and withdrawn gains. Completely passive after setup. Compounds over decades. Should grow to 20 to 40% of income. Stream 5, royalties or IP, passive. 2,000 to 20,000 euros per year. Courses, books, patents, or licenses. Create once, earn forever. Scalable without time input. Bonus stream, 5 to 15% of income. European path. Age 25 to 30, build foundation. Salary, 45,000 euros. Side business, 5,000 euros. Start investing, 15,000 euros per year. Total income, 50,000 euros. Age 30 to 35, expand. Salary, 60,000 euros. Side business, 20,000 euros. First rental property, 3,000 euros cash flow. Investment portfolio, 2,000 euros dividends. Total income, 123,000 euros. Age 40 to 45, freedom point. Salary, 0 euros, quit job or go part-time. Side business, semi-automated, 40,000 euros. 2 rental properties, 18,000 euros cash flow. Investment portfolio, 20,000 euros dividends. Online courses or products, 12,000 euros. Total income, 90,000 euros without a full-time job. This is how Europeans achieve financial independence. European side business ideas. Service-based, B2B. Software development or consulting, 75 to 150 euros per hour. Marketing or SEO services, 50 to 100 euros per hour. Accounting or tax advice, 80 to 150 euros per hour. Engineering consulting, 70 to 120 euros per hour. Legal services for lawyers, 150 to 300 euros per hour. Digital products. Online courses, Udemy, Teachable, 20 to 200 euros per course times 100 to 1,000 students. Ebooks, 10 to 30 euros times 500 to 5,000 sales. Templates or tools, 15 to 50 euros times 200 to 2,000 customers. Photography or design, stock sites, 0.5 to 5 euros per download times 10,000 to 100,000 downloads. E-commerce. Amazon FBA in Europe, 2,000 to 10,000 euros net per month after scaling. Dropshipping, 1,000 to 5,000 euros per month. Print on demand, 500 to 3,000 euros per month. Why multiple streams matter. Security. Lose job, other income continues. Acceleration. Multiple sources compound wealth faster. Tax optimization. Business income has different, often better tax treatment. Freedom. Not dependent on any single source. Build income diversity like you build investment diversity.
Creating your personal financial plan. Theory is useless without action. Here's your personal plan. Step 1. Calculate your numbers. Net worth, assets, cash, investments, real estate equity, business value, minus liabilities, mortgages, loans, debts. Net worth. Target 100,000 euros by 30, 300,000 euros by 40, 750,000 euros by 50, 1,500,000 euros by 60. Monthly surplus, income after tax minus essential expenses, housing, food, transport, insurance, quality of life, hobbies, social experiences, available for wealth building. Target 30 to 50% of net income. Financial independence number. Annual expenses times 25 equals FI number. Example, 35,000 euros expenses times 25 equals 875,000 euros needed. Step 2. Set clear goals. 1-year goals. Emergency fund, 10,000 euros. Start investing, 500 euros per month. Pay off high-interest debt. Launch side business. 5-year goals. Investment portfolio, 50,000 euros. Side business income, 1,500 euros per month. Bought first rental property or down payment saved. Net worth, 100,000 euros plus. 10-year goals. Investment portfolio, 200,000 euros. Real estate, 1 to 2 properties. Side business, 3,000 to 5,000 euros per month. Net worth, 500,000 euros plus. 20-year goals. Financial independence achieved. Portfolio, 750,000 euros to 1 million euros. Real estate, 300,000 euros to 500,000 euros equity. Passive income, 3,000 to 5,000 euros per month. Work optional. Step 3. Implement systems. Automatic investing. Set up automatic monthly ETF purchase, 500 to 2,000 euros depending on income. Use DeGiro, Trade Republic, or IBKR. Choose WVCE or similar world ETF. Never stop, never pause, never try to time it. Automatic savings. Separate account for house deposit, emergency fund, major purchases. Automatic transfer after salary hits, 300 to 1,000 euros per month. Expense tracking. Use app, Yanb, Mint, or Simple Excel. Track for 3 months to understand spending. Identify cuts without sacrificing happiness. Income tracking. Record all income sources monthly. Celebrate growth. Identify optimization opportunities. Quarterly reviews. Every 3 months, check progress. Net worth growing? On track for annual goals? What to adjust? Step 4. Optimize continuously. Every 6 months, negotiate salary or ask for a raise. Review side business prices. Raise them. Check if you can increase investment contributions. Reassess goals. Are they still right? Every year. Rebalance portfolio. Review tax situation. Can you optimize? Calculate net worth growth. Adjust next year's targets. Step 5. Avoid lifestyle inflation. The rule, when income increases by 10,000 euros, 5,000 to wealth building, investments, real estate, 3,000 to taxes, it's automatic anyway, 2,000 to lifestyle improvement. This way, lifestyle improves, but wealth building accelerates. European example. Promotion. Salary from 50,000 euros to 62,000 euros net, plus 12,000 euros. Don't do this. Upgrade apartment plus 400 euros per month equals 4,800 euros per year. Buy new car plus 300 euros per month equals 3,600 euros per year. More expensive holidays plus 2,000 euros per year. Restaurants and lifestyle plus 200 euros per month equals 2,400 euros per year. Result, spend all 12,000 euros, save same as before, no wealth growth. Do instead, increase investments plus 500 euros per month equals 6,000 euros per year. Quality of life improvements plus 200 euros per month equals 2,400 euros per year. Rest into taxes or savings. Result, wealth building jumps 60%, lifestyle improves modestly. Stay on track. This discipline separates wealthy from comfortable. Protecting your wealth. Building wealth takes decades. Losing it can take days. Protect it. European wealth protection. 1. Emergency fund. 6 to 12 months expenses in cash. High-yield savings account. 4% plus in 2026. Access immediately if needed. Never invest this money. Protects from forced asset sales. 2. Insurance coverage. Life insurance, if you have dependents. Term life insurance, 200,000 euros to 500,000 euros coverage. Cost, 20 to 60 euros per month depending on age and health. Only needed if others depend on your income. Disability insurance. Replace income if you can't work. Critical. Your earning power is your biggest asset. Cost, 50 to 150 euros per month. Often provided by employer, check coverage. Liability insurance. Protects from lawsuits, accidents. Very cheap in Europe, 5 to 15 euros per month. 1 million to 5 million euros coverage. Essential if you own property or business. Property insurance. Home and contents insurance. Rental property insurance. Cost 20 to 50 euros per month per property. 3. Legal structures. Hold business in separate entity, BV GmbH Ltd. Protects personal assets if business fails. Essential if business has any liability risk. Consider holding company. Operating company owned by a holding company. Extra layer of asset protection. Common in the Netherlands, Germany. Prenuptial agreement. Uncomfortable topic, but protects wealth in divorce. Standard among wealthy Europeans. Not romantic, but practical. 4. Diversification. Asset diversification. Not all wealth in one country. Not all wealth in one asset type. Geographic spread reduces country-specific risk. Currency diversification. Hold some USD assets, S&P 500 ETFs. Some Euro assets, European stocks. Maybe some CHF, Swiss franc, safe haven. Bank diversification. EU deposit insurance, 100,000 euros per bank per person. Spread cash across banks if over 100,000 euros. No need to go crazy, but be aware of the limit. 5. Estate planning. Will or testament. Specify who gets what. Without will, state decides. Essential if you have children, partner, or significant assets. Beneficiaries on accounts. Investment accounts can have named beneficiaries. Speeds inheritance process, avoids probate in some cases. Trust structures, advanced. Not common in Europe like US, but Netherlands, UK, and Luxembourg have options. For high net worth, 2 million euros plus. Consult estate lawyer. Protect what you build. Offense and defense both matter.
Your action plan. We've covered everything. Theory, strategy, tactics, psychology. Now comes the only thing that actually matters. Action. Your 30-day action plan. Week 1, foundation. Day 1 to 2, calculate net worth, monthly surplus, FI number. Day 3 to 4, open investment account, DeGiro, Trade Republic, IBKR. Day 5 to 7, set up automatic monthly investment in VWCE or similar ETF. Week 2, optimization. Day 8 to 10, review all expenses, identify 200 to 500 euro per month savings. Day 11 to 12, set up separate savings account, automatic transfers. Day 13 to 14, research side business ideas in your skills area. Week 3, education. Day 15 to 17, read about your country's tax system and optimize. Day 18 to 19, learn about business structures, BV/GmbH/Ltd. Day 20 to 21, research real estate markets if interested. Week 4, momentum. Day 22 to 24, launch basic version of side business, website, first client outreach. Day 25 to 27, set annual financial goals, quarterly review calendar. Day 28 to 30, share plan with partner or accountability friend and commit publicly. After 30 days, you'll have active investment account, automatic contributions set up, lower expenses, side business launched, clear one-year goals, momentum. The most important thing, don't try to be perfect. Don't wait until you've learned everything. Don't overthink. Pick VWCE. Invest 500 euro per month,
Do it for 20 years. You'll be wealthy. Everything else is optimization. Nice to have, not essential. The difference between wealthy and poor Europeans isn't knowledge, it's action. You've now learned in 60 minutes what took wealthy Europeans decades to figure out. The question is simple. Will you act on it? Or will you watch this video, think, that's interesting, and do nothing? 5 years from now, you'll either Path A, 30,000 euros invested equals 180,000 euros portfolio at 7% growth. Side business earning 2,000 euro per month. First rental property bought, net worth of 250,000 euros plus. You'll thank yourself. Path B, 0 euros invested equals 0 euros portfolio. Same job, same salary, stressed. Renting, paying someone else's mortgage. Net worth of 15,000 euros, just savings account losing to inflation. You'll regret inaction. Which path do you choose? Start today. Start small, but start. The European wealth system is yours to use, legally, ethically, effectively. Build your future. Build your freedom. Build your wealth. See you on the other side.